All right, we're about to dive deep into some huge forces that are shaking up the economy. We're going to look at this showdown between the White House and the Federal Reserve, what it means for stocks and housing, and why one specific date, May 2026, could be a massive turning point, a total economic reset. Let's figure out why.
So let's just kick things off with this really powerful claim from our source material. The idea that come May of 2026, everything, and I mean stocks, real estate, the value of your money, is on a collision course for a complete and total reset. That is a huge statement, so let's unpack what's really behind it.
So this really gets to the heart of the mystery we're tackling today, right? What is so special about 2026? What does a reset even look like? And probably the most important question for all of us is, what could this actually mean for your money and your financial future? We're going to explore every piece of that puzzle.
Okay, so at the very center of all this uncertainty is this major power struggle. It's a battle between the White House and the Federal Reserve, and it's a battle over your money. The outcome here is going to have massive consequences for pretty much everyone.
This slide really lays out the two completely different paths we could go down. On one side, you have this political vision to slash interest rates, maybe down as low as 1%, all to get people spending and to fire up economic growth. But on the other side, you've got the Fed, led by Jerome Powell, saying, whoa, not so fast. Their approach is all about making decisions based on data, not politics, to protect the Fed's credibility.
And make no mistake, this is not just some friendly disagreement. Our source points out that the pressure on the Fed is getting really intense. We're talking about things like grand jury subpoenas from the Department of Justice, threats of criminal indictment, and even the removal of a board member. These are some pretty serious tactics, and many see them as direct attempts to force the Fed's hand on interest rates.
The stakes here are absolutely enormous. I mean, if the Federal Reserve starts to look like it's just caving to political pressure and losing its independence, its credibility on the world stage could just crumble. And if that happens, you could see other countries losing faith and starting a global sell-off of US dollars. The ripple effects from that would be, well, huge. So you have this high-stakes battle going on. How does that actually trickle down to the markets? Well, it basically creates two completely different competing futures for stocks and for housing. Are we headed for a massive boom, or are we staring down a pretty sharp bust?
And this table really captures the tug-of-war perfectly. You've got the bulls, the optimists who are betting on this AI supercycle and the promise of lower interest rates to kick off what they call a great melt-up. That's a super fast, explosive rise in prices. But then you have the bears, the pessimists. They're looking at trade tensions, a potentially weaker dollar, and an economy that seems to be held up only by the wealthiest spenders. And they're warning that these super high valuations could lead to a sudden, painful crash.
Now, this same kind of gridlock is happening in the housing market too. It's basically at a standstill. You've got sellers who don't want to budge on their prices because they think a flood of buyers is coming as soon as rates drop. And at the same time, you've got all these potential buyers just sitting on the sidelines, waiting for exactly that, for mortgage rates to become affordable again. It's a total standoff. So one idea being floated to try and break this logjam is to pump $200 billion into the mortgage markets. The goal is simple: artificially push down mortgage rates and make houses more affordable. But the question is that really enough to move the needle? Well, let's put that number in perspective. When you take that proposed $200 billion and you compare it to the entire U.S. mortgage market, which is a whopping $11 trillion, suddenly it looks like a drop in the ocean. Our source suggests it's really just a blip on the radar, something with a tiny temporary impact that the market probably already expects anyway.
And this all raises a really critical question, which is summed up perfectly here by Peter Schiff. If the housing market is in a bubble, is pumping more money into it to keep it inflated really the right move? Schiff's argument is that you're just making the inevitable pop that much worse down the line. Which, of course, brings us right back to the main event, that 2026 date. So let's really dig into why this year could be so pivotal and how a little bit of history might just give us a clue about what's coming next.
You know, history doesn't repeat, but it often rhymes. And the source material points to this incredible parallel from the late 90s. Back then, the Fed chair, Alan Greenspan, famously warned about irrational exuberance in the market. Basically, investors getting way too confident and ignoring all the risks. But he didn't raise rates, and the market went on this massive late-stage melt-up for a few more years, right before the dot-com crash in 2001. The fear is we're seeing a repeat performance, a scenario where a new Fed chair is pressured to keep things cheap, leading to one last huge rally, followed by a crash. And that critical date? May 2026. That's when Jerome Powell's term is officially up.
Okay, so we've talked about all these high-stakes conflicts, historical echoes, potential melt-ups and meltdowns,
But what does any of this actually mean for you and your finances? How do you even begin to prepare for a future that seems so unpredictable?
And this, right here, is the absolute key takeaway. According to our source, the biggest risk for you right now isn't the fear of missing out on more gains if the market rips higher. No, the real danger is being overexposed, having too much on the line in a market that's essentially being held together by fragile things like expectations, politics, and just plain overconfidence, things that can vanish in a heartbeat.
So, what's the game plan for this potential 2026 reset? Well, the advice isn't some secret trick for timing the market. It's actually about building financial resilience, a fortress. First, make sure your investments are diversified, so all your eggs aren't in one basket. Second, attack any high-interest debt you have. Third, build up a solid cash fund for emergencies. And finally, and this is so important for surviving the kind of volatility we're talking about, get your finances to a place where you will never, ever be forced to panic sell at the absolute worst possible time if that reset does come.
And that really leaves us with the ultimate question. In a market where so much of the value is propped up by belief, by confidence, and by political promises, what happens when that belief finally breaks? That's the billion-dollar question we're all facing. Thanks so much for joining me.